Rambus just delivered a massive beat for the second quarter of 2026. I mean, crushing consensus estimates across the board. They blew past the top end of their own guidance range, delivering a record $207.4 million in revenue.
Which is a 20% jump year over year.
Right, exactly. And, moving to the bottom line, non-GAAP diluted earnings per share came in at $0.77. That is up 24% year over year.
Yeah, and looking forward, the momentum seems completely intact.
It really does. Q3 2026 revenue guidance is set between $210 million and $216 million, with non-GAAP EPS expected to land between $0.75 and $0.82.
So they are not slowing down anytime soon.
Not at all. So the mission for you today is unpacking the mechanics behind why Rambus is succeeding at this exact moment. We're going to break down their segment performance, uncover the engine of this revenue beat, evaluate the margins and cash flow, and crucially, identify the specific execution risks you need to monitor heading into the back half of the year.
Because beating the top end of your own revenue guidance by nearly $10 million in a single 90-day window, well, it's a glaring signal.
Right, their internal models just fundamentally underestimated customer demand.
Exactly. 3 months ago, management anticipated a specific trajectory, and something in their core market just accelerated drastically.
Yeah, pulling forward purchase orders at a rate they simply didn't foresee. So to figure out what broke the models, we have to look at exactly where that $207.4 million originated. Breaking down the revenue mix reveals a completely lopsided growth story. Product revenue hit an all-time record of $99.2 million.
Which is a 13% sequential increase from Q1.
And a staggering 22% jump year over year. You pair that with the legacy royalties revenue, which brought in a highly stable $84.2 million, and then contract and other revenue making up the remaining $24.0 million.
Okay.
Let's unpack this. Product revenue skyrocketing 22% in 12 months is a wild metric for a hardware company.
It really is, yeah.
I mean, dealing in physical semiconductor components and intellectual property, I have to push back on this growth narrative a bit. Selling hardware doesn't scale effortlessly like a software as a service model,
Right, you can't just click a button to spin up a new AWS instance.
Exactly. Designing, fabricating, shipping physical chipsets, it's capital intensive and notoriously slow. So are they actually moving that much more physical volume? Or are they simply exploiting pricing power because hyperscalers are desperate for anything labeled AI infrastructure?
Well, what's fascinating here is that the volume scaling is entirely genuine.
Really?
Yeah, and it's happening because the physical bottlenecks inside data centers have reached a critical breaking point. To understand that 22% surge, you have to look at the specific technology they are deploying.
Right, stuff in the earnings deck.
Exactly. The deck points directly to their next-generation offerings. They're delivering complete chipsets for DDR5 9600 server memory modules alongside their PCIe 7 switch IP.
So they aren't just jacking up prices on legacy parts.
No, not at all. They are moving massive volume on the exact ultra-premium, high-bandwidth architecture that data centers literally cannot function without if they want to run modern artificial intelligence.
Okay, so for the retail investor trying to visualize the inside of a server rack, we need to clarify what these specific technologies actually do. I mean, DDR5 9600 and PCIe 7 sound like alphanumeric soup.
Oh, they definitely do.
But they are essentially the central nervous system of the motherboard, correct?
They are the absolute foundational plumbing of the data center. PCIe 7, for instance, is the data transfer protocol that dictates the absolute maximum speed at which the CPU can communicate with the GPU.
Wow, okay.
Yeah. It also dictates how fast that GPU can pull data from the network interface card. And every time an industry standard upgrades to a new PCIe generation, the bandwidth effectively doubles.
That's a massive leap. And what about the memory side?
On the memory side, those DDR5 9600 modules are currently pushing the absolute physical boundaries of how fast short-term memory can operate without overheating or, corrupting the data stream.
So Rambus isn't actually manufacturing the massive $30,000 GPUs that grab all the headlines.
Exactly, no. They engineer and sell the highly specialized silicon IP and memory controllers that ensure that $30,000 GPU isn't sitting idle for microseconds at a time, just starved for data.
That reframes the hardware demand entirely. If a tech giant is spending billions on fleets of GPUs, they are actively bleeding money every fraction of a second. Those processors sit idle, waiting for a data packet.
Exactly. The opportunity cost of idle compute is astronomical.
Which means this sudden surge in hardware demand isn't happening in a vacuum. It's being driven by a specific evolution in how AI is utilized. Rambus CEO Luke Seraphin explicitly highlighted this long-term thesis on the earnings call.
Yes, he emphasized that the company is structurally positioned to capitalize on secular trends.
Specifically driven by the rapid expansion of, quote, AI inference and agentic workloads. Now, here's where it gets really interesting and where I have to play the skeptic for a minute.
Go for it.
Every tech executive on the planet is currently injecting the letters A and I into their earnings scripts to artificially boost market sentiment.
Oh, absolutely. It's rampant.
Right, but Seraphin very specifically chose the terms AI inference and agentic workloads. So is there a genuine physical architectural shift happening on the server side that requires new hardware? Or is this just corporate buzzword bingo designed to make a memory controller company sound like an AI pioneer?
That is the perfect question. Distinguishing between those specific terms is basically the master key to understanding this entire earnings report and that 22% product growth.
Yeah, lay it out for us.
So for the last few years, the entire technology sector has been consumed by the AI training phase. Training requires brute force, massive computational power.
Right, feeding billions of static parameters into a model repeatedly until it learns a pattern.
Exactly. The data movement there is highly predictable and linear. However, AI inference is what occurs when that fully trained model is deployed into the real world to actually do a job.
Like a large language model answering a user's prompt in real time.
Or a computer vision system recognizing a pedestrian on a street. It requires the instant, unpredictable recall of scattered data. And agentic workloads escalate that demand exponentially.
How so? Because an agentic AI doesn't just answer a single question and go dormant, right?
Precisely. It acts autonomously to perform complex, multi-step tasks. If you task an AI agent with researching a competitor, drafting a report, and emailing it to a team, that agent has to constantly fetch external data.
Cross-reference internal databases, trigger new actions across a vast network.
Yeah, without human prompting. When AI behaves that way, the primary bottleneck is no longer processing power. The bottleneck shifts entirely to memory and bandwidth. It becomes a chaotic data movement problem.
We are talking about the memory wall.
Yes, the infamous memory wall.
Let's visualize this. Imagine a Michelin star chef that represents your massively powerful GPU. The chef has incredible knife skills and can chop vegetables at lightning speed far faster than any human.
I love this analogy.
But the waiter, which represents the server's memory bandwidth, can only bring the chef one single carrot at a time from the pantry.
So the chef is just standing there starving for ingredients.
Exactly. The kitchen's output isn't limited by the chef's processing speed. It's severely limited by the waiter's walking speed. Rambus is essentially firing the waiter and building a high-speed industrial conveyor belt directly from the pantry to the chef's cutting board.
That captures the mechanics perfectly. When Seraphin highlights agentic workloads, he is signaling to institutional investors that as AI becomes increasingly autonomous and erratic in its data retrieval, the traditional waiter simply cannot keep up.
So the physical architecture of the data center has to fundamentally change to support that traffic.
Right. The need for Rambus's high-bandwidth DDR5 chipsets and their ultra-fast PCI 7 IP transitions from being a luxury upgrade to a structural requirement. The conveyor belt has to be built, or the entire concept of autonomous AI agents falls apart.
But building massive industrial conveyor belts requires immense capital. Riding a generational tech wave creates a fantastic narrative for the top line. But we must run a financial health check to see how this translates to the bottom line.
Absolutely, because countless companies are currently incinerating cash trying to pivot their infrastructure to meet AI demands.
Yeah, we need to evaluate if this revenue beat is generating real profit or if Rambus is just buying its own growth. Looking at the profitability metrics, there is a very specific gap between the GAAP and non-GAAP figures that requires some clarification.
There always is in tech.
Right. They reported $93.7 million in non-GAAP operating income. That translates to a massive 45% non-GAAP operating margin. But the strict GAAP operating income came in significantly lower at $72.7 million.
So that $21 million bridge between the two figures is where retail investors often get tripped up when analyzing tech earnings. The vast majority of that gap comes down to one item, which is stock-based compensation.
Of course.
In Q2, Rambus backed out approximately $16 million in stock-based compensation expense to arrive at that non-GAAP number.
And there were a couple other small things too, right?
Yeah, they excluded roughly $2 million for the amortization of acquired intangible assets and about $3.3 million in restructuring charges.
Stripping out non-cash items is the standard playbook across the tech sector to highlight operational cash generation. But that $16 million in stock-based compensation is still real dilution for the retail shareholder.
It is.
I mean, it might not drain the corporate checking account today, but it permanently expands the share count and dilutes equity.
It absolutely creates dilution, and investors must model for that. However, the critical distinction for evaluating their immediate operational health is that stock-based compensation does not consume operating cash flow.
Okay, that makes sense.
And when you analyze the core business, even if you reject the non-GAAP metrics entirely and strictly use GAAP, the operations are incredibly lucrative, generating $72.7 million in pure GAAP operating income on $207.4 million in revenue yields a 35% GAAP operating margin.
Wow. Finding a company that designs physical semiconductor components and maintains a 35% strict GAAP margin is exceedingly rare.
It speaks volumes about the immense pricing power they currently wield over these DDR5 chipsets.
And that operational efficiency is flooding the balance sheet with liquidity. This is where the numbers transition from just a solid quarter to a massive structural advantage. In Q2 alone, Rambus generated $61.2 million in pure cash from operations,
Which is a huge number for them.
If you track their balance sheet summary over the last 5 quarters, that level of cash generation isn't an anomaly. It is a highly consistent trend. Their total cash and marketable securities now sit at an astonishing $824.9 million against total assets of $1.61 billion.
Yeah, that is a fortress balance sheet.
So what does this all mean? When I look at a capitalization structure featuring nearly $825 million in liquid assets and literally zero debt, I see a company that is entirely insulated from the current interest rate environment. How does this specific balance sheet position them against competitors?
If we connect this to the bigger picture, possessing zero debt and a cash pile approaching $1 billion is a massive offensive weapon in the semiconductor IP space. Developing next-generation technology like PCIe 7 is punishingly expensive.
Oh, I can only imagine.
Yeah. In this quarter alone, their GAAP research and development expenses hit $51.1 million, which is up from $46.3 million a year ago.
And that continuous heavy capital deployment is just the absolute minimum requirement to sustain product leadership in this industry.
Exactly. You cannot rest on your laurels when data transfer speeds need to double every single generation.
Because you can't fake your way to the next generation of server bandwidth. You can't just issue a clever press release about AI. You have to spend the hard engineering dollars to design, test, and validate the silicon.
And because Rambus is organically generating over $60 million in operating cash flow every 90 days, they can entirely self-fund that escalating R&D budget. They don't have to touch their $825 million cash reserves.
That's a huge advantage right now.
It really is. And more importantly, they don't have to go to the bond market and borrow money at elevated interest rates. Furthermore, in a macroeconomic environment where capital expenditure can freeze overnight, being completely debt-free means they aren't beholden to outside lenders if the hyperscalers suddenly delay a wave of server upgrades.
They maintain total control over their operational destiny.
Absolutely.
But maintaining control of your own balance sheet doesn't mean you are immune to the broader market cycle. Having $1 billion in the bank and world-class technology doesn't matter if you can't actually get the hyperscalers to sign the purchase orders.
Right. The execution still matters.
Which brings us to the Q3 outlook and the notable risks. They are guiding for robust $210 to $216 million in revenue next quarter. What are the specific mechanical hurdles that could derail that momentum in the short term?
This raises an important question about how enterprise sales actually function in the semiconductor IP sector. The earnings materials and the safe harbor disclosures explicitly state that achieving the targeted Q3 revenue is, quote, not without risk.
Interesting phrasing.
Yeah, to hit that $210 to $216 million mark, Rambus must successfully execute and sign very specific customer agreements for both product sales and solutions licensing before the quarter closes.
And these are not software subscriptions that automatically renew on the first of the month with a credit card swipe.
No, not at all. Every single one of these deals is a complex, negotiated enterprise contract. The product side is highly transactional and deeply dependent on physical supply chains cooperating.
And the licensing side.
The licensing side, while eventually generating those highly profitable, steady royalties we discussed earlier, relies on successfully navigating massive intellectual property agreements with global corporate entities.
Which take forever.
Oh, they take months. They involve rigorous engineering validation, exhaustive legal reviews, multi-tiered procurement sign-offs. If a major data center customer decides to pause their capital expenditure for just 4 weeks to reassess the macroeconomic climate,
then that contract slips from Q3 into Q4 and Rambus misses its guidance.
Exactly. Furthermore, their disclosures heavily emphasize their vulnerability to the broader geopolitical and macroeconomic environment. Rambus is essentially a Tier 1 supplier to the data center ecosystem.
Right. So any broad slowdown in capital expenditure spending by the major hyperscalers, whether driven by inflation, interest rate anxieties, or geopolitical supply chain shocks, acts as an immediate headwind.
Yeah, if the big tech players collectively decide to tap the brakes on their AI infrastructure build-out, Rambus cannot force them to buy memory controllers.
The execution risk is immediate and constant. The deals must be negotiated, signed, and delivered within a strict 90-day window, and the macro environment has to remain stable enough for hyperscalers to continue deploying billions into infrastructure.
That's the reality of the business.
But zooming out to survey the entire landscape of this Q2 report, you have a company generating record product revenue, holding immense pricing power with 35% GAAP margins, and sitting on an incredibly clean, debt-free balance sheet. And that leaves us with one final, unaddressed reality hidden in this data, pointing directly at that massive $824.9 million cash pile, the absolute zero debt, and a very specific, deliberate mention in the safe harbor statement regarding the, quote, demand for existing and newly acquired technologies. You have to wonder, is Rambus content to just organically fund its AI infrastructure R&D? Or is this massive, unencumbered war chest actually being prepped right now for a major strategic acquisition to ruthlessly consolidate their power in the data center memory market? Follow the show for daily, completely unfiltered earnings coverage.